Yeah,
Now,
so we
now
live.
this is public.
This is unlisted.
This is unlisted. Okay,
Yeah.
so we chilling.
Yeah. So hey, smooth episode 2,
We
Path to
chilling.
Peculiar.
Yes, sir.
And I figure with this episode, we go ahead and just continue our conversation from earlier. That was also a full episode of Path
Hey,
to Peculiar.
I'm gonna stop calling you and I'm gonna start declining your calls because every time we get on the phone, bro, it's a full episode recorded. Legit.
Hey, since the last episode, we done recorded probably at least a good
For real.
6, 7 more episodes worth. So
Yeah.
Jay Fu, we was talking earlier about well, we kind of broke it up. One, if you were given $1,000 to invest,
Mm-hmm.
how would you go about doing it? Or if you were given $200,000 to $300,000, how would you go about investing that? So
Yeah.
we kind of went back and forth talking about how our different approaches was, and I kind of share with you how my approach is slightly transforming the tad, but it's still overall. I think we're still synced up and kind of our approach with things. You want
Yeah.
to kick it off and talk about if I said AJ Flu,
Yeah.
I got 100 bands for you.
Yep.
What you gonna do with it?
Yeah. Yeah. That's tough. I love that question though. Well, I can start off by saying anybody who comes and joins this particular episode, appreciate everybody coming through, showing love for the first episode that we dropped. I mean, for me, it kind of ran it up. It was over like 100 views pretty quick, so I appreciate everybody coming through, showing love there. But as far as where I would invest, and the reason why I love this question is because I feel like it's a lot deeper. Like somebody's response is a lot deeper than just, "Hey, I would do this, I would do this." It really just kind of tells where somebody's trust is when it comes to what's going to give them the returns that they're looking for. And I'm still trying to figure this out. But if you said to me that I had $100,000 and I had to invest it somewhere, I likely would probably try to diversify it amongst a couple of different things. To me personally, real estate is probably the top of my list to start getting into investing in. And the reason why, and I don't know if all this is accurate, but I feel like if you're able to invest in a rental property, then you could make money a couple different ways. And so, one, like if you do have renters that come in, you'll have that income on a monthly basis. But then at the same time, if that property value should increase, you're also making money that way as well. Now, I do know also in the same hand, you're going to have more expenses that come with that. So, you got property taxes or the mortgage that you might be paying off if you still have the mortgage on that. So that's going to be a part of it. Even after you pay the house off completely, you still are going to have the property tax. That's not going to go away. So that's an expense there. And then also if you are renting that out or Airbnb or what have you, you're going to have some type of maintenance that's going to come across at some point. And so those are some things to think about as far as expenses, but that's the number one for me. If I was to maybe split it half and half, then the rest I would likely just put into the stock market, kind of following the strategy that I have been for the last few years, just looking at companies that have that long track record of success. That's where I feel most comfortable as far as my investments.
Yeah, that's real. And so,
So
kind of,
same question to you though. Same question to
yeah,
you. So if I went ahead and said, "Hey, you got 100K and you got to invest it somewhere," what does that look like?
yeah. And so before I kind of dive into my numbers, my nitty gritties. Remember, I told you before, I am super anti debt, but I'm starting to merge into this environment where, okay, my risk tolerance to take on debt in order to build with wealth has slightly modified. Meaning, for me, I'm willing to take on a moderate or a low amount of debt in order to, as long as the returns are right, right? So,
Right.
for instance, with this 100 grand with me, I'd buy a rental property for around 150,000, right? And so what I would take is that 50,000 or excuse me, 30,000 down, to only finance about 120. And because I don't, even though I know the most aggressive of wealth builders, they have 100% of their capital deployed at all times. I'm not particularly comfortable with that. I like to be able to access emergency funds right away should I need them. And kind of like how you mentioned earlier, your personal finances, you have an emergency fund, I see my investments as the same way, right? So I think we agreed it there. So with that 30,000 down, so now my debt or how much I'm asking to borrow from a bank to kind of realize that that mortgage would be about 120. So for me, I see my emergency fund for that particular investment would then be 10%. So I'd say another 12,000. So 12,000. So that's what, at 42,000 right there. I'm in on that property. As far as the 30,000 down or 20%, and then my 15 or 12, excuse me, as my emergency funds. From there, I take an additional probably 30 to 40, and I put it into a few of the stocks, the key stocks that I've been kind of investing in lately, which is I'm definitely throwing some into Tesla, throwing some into Apple, and then I'm throwing some into Facebook or other or what we're now calling Meta, because I really think they're going somewhere with this metaverse and all that stuff. I think that's kind of the future. So, and then I would take probably another 10 and throw it towards 10. So what's that? I'm at
don't have me, bro.
I'm at about, so let's say I'm at about 82, right? So I said 40. So I take the rest, the 18 or so, and I throw that into the S&P 500 index fund, right? And so some of that money is kind of doubled, right? Because Tesla, Apple, and Facebook, aka Meta, are also in S&P 500. But I would probably do it that way. I may modify the numbers. I may even put down 50 down. I may modify the numbers, but I guess the overarching theme of what I would do with the money is I would diversify it right now amongst the stock market and mortgage. Probably no other investments at this point in time. I think that's my approach.
Yeah. I feel that. Yeah, I mean, like we were talking about before, the way that I look at it, I'm not going to look at any particular investment strategy and say that that's completely wrong.
Right.
I'm open to learning about some different strategies that are out there that maybe I might be able to adopt and kind of launch on what I'm doing. So I can't say from my side, because I'm extremely anti-debt, and that comes more from a place of my personal experience. Where I came out of not having anything to my name at one point, and then after that, I was able to recover somewhat, but I still didn't have the understanding when it came to how to manage finances. I was still living paycheck to paycheck. So I wasn't really making any traction on trying to set myself up for my future.
Yeah.
So then once I started learning a little bit more about some different things I could do and some strategies I could deploy, one of the main things, and I remember I was talking to my little sister about this, because she was the one who introduced me mostly to Dave Ramsey from the standpoint of getting out of debt. And so I was like, okay, let me go ahead and follow these baby steps. And so as I went through, I went through them strategically. I put aside money for kind of the starter emergency fund, and then I started looking at the debt that I had. A lot of it was consumer debt, credit cards, etc. When I started looking at these credit cards, there was a credit card that I had, bro, and it was, the limit of it was not even that high. I want to say it was maybe like $2,500, something like that. And at one point I had maxed it out, and I was paying the minimum. And so I was paying the minimum on that card for, I swear it was probably like 2 years or so, at least 2 years.
Yeah.
And so then when I wanted to try to clear everything up, because I was trying to get my credit score up, but when I was trying to clear everything, I was like, all right, let me go ahead and pay this off. And I was thinking to myself, okay, I've been paying this for at least a couple of years, maybe a few years at this point. So, I mean, the balance can't really be nothing. I can knock it out real quick, right? Bro, the interest rate on that credit card had to be phenomenally high, because let's say if the maximum was 2,500 where I maxed it out, I was expecting that I could pay it off and like, $1,000, something like that. Try to knock it out. That jump was still probably somewhere around $2,000 after a couple years of paying. And in my mind, I'm thinking, okay, it's kind of knocked it down, even though I'm paying the minimum. No, all of that money was just going to the bank for nothing, bro. I was just giving in my bread.
Yeah.
So
yeah, that's crazy. See, I think that's where you and me are probably align the most when it comes to finances, that extreme dislike for debt. And it's kind of weird, Jay Flu, because I'm in this weird no man's land to where I have I'm extremely, when it comes to debt, I just don't like it. I'm not a fan of it. Our household is debt free. We don't owe anybody a dollar. But then there's this weird part where I'm like, well, cool. Well, it was something that struck a chord with me when I started realizing, well, there's only certain, based on my financial structure right now, there's only certain places that I could put a dollar and it makes sense. And then I started doing some research into what the banks kind of do with the money that you have in your savings account, for instance. They're taking that, they're loaning that out multiple different ways and making a return on that investment, and then giving you 0.1% or 0.01%.
Taking you back 0.01.
Right. And I'm sitting there thinking like, man, that's so somebody out there got my money and I, got my money and it's working for me. So how I'm now justifying assuming debt to build wealth is that, for one, I was trying to create some rules, some guardrails for this, for me being able to leverage debt. And one of my guardrails that I said is that it has to be for an asset. Definitely can't be for a liability. So no cars, those sort of things, right? So it has to be an asset. And I also have to be able to bring in more revenue than the interest, if that makes sense. So
for sure.
For instance, if I'm paying, if I'm paying interest on it, I have to be able, my revenue or return has to be able to beat with the interest rate that they're charging me would be. And so the only thing justifiable, and another rule for me is, though it is an investment and there's, that there's inherently risk associated with it, that the expense, right? So that $150,000 house that I talked about earlier. So I calculated the mortgage out for me, in my situation, based on interest rates that I'd be able to get, is about $700 a month. So with my example, I'd need to be able to cover that out of my discretionary or disposable income, personal income, in order for me to feel comfortable engaging in that investment. And I know there are people who build wealth and they do it by leveraging debt. And they would think of my strategy as a complete ridiculous, right? Because it's a slower way of doing things.
Right.
But one of the things I think you and me kind of cracked a nut on earlier is that I don't think that when you have a goal of building wealth, right? There's no, technically, as long as you're building some type of wealth, there's no right or wrong path. What drives or makes something right or wrong is our individual tolerance for risk. So for me, my tolerance for risk when it comes to debt is very low. I have a low tolerance for risk. So what I could have done with that 100 that you gave me is I could have put 30,000 down on 3 different rental properties. Some people might find that as a sound investment strategy, and I would knock them if they did. But for me, and yes, that's triple the revenue, that's triple the risk. That's a lot of different things. I can grow wealth a little bit faster. I'm growing not only my expenses that I'm making on the property every month, but also the increase in the value of the home, and that's times 3. And I think that that's a way for some people, and some people would approach building wealth that way. But for me, my tolerance for risk and accepting debt in order to build that wealth is just not there. It's low. So those are kind of the guardrails that I set that kind of justify, I guess, my future leveraging a debt for the purposes of building wealth. But I think it's important that even if you are leveraging debt, that we just don't speed. You know what I mean? Because it's very fast. It's very easy, especially if you got your credit up, you got some income coming in. A bank is going to give you some money, right?
For sure.
If you don't have the infrastructure built out well, I think it's definitely a crawl before you walk type of scenario for me. I'm not trying to bite off more than I could chew.
Yeah, for sure. No, I think I agree with the point that I can't say that there's any one right way as far as investing and trying to generate enough revenue off that investment to build wealth. I can't say there's a particular right or wrong way. I think personally that it comes down to the individual and their experience. Where are they comfortable? So whether you're talking about real estate or the stock market or crypto, etc., where is somebody comfortable placing their money and trusting that they're going to see that return? Now, one of the things for me personally that might differ from how a lot of people invest, I don't look at any short-term type of returns. Like the returns I look for are all going to be longer term wherever I put my money, that I'm not really looking to take that money out or leverage that money for 10, 15, 20 years down the line. So that's where I feel comfortable. And then again, I'm looking at organizations that have that longer track record of success. And I would say, and we're talking about investing a lot here, but I would say before you go into investing in anything, getting an understanding and getting some knowledge or just understanding some data behind, okay, why are you investing in that thing particularly? Because that's where your comfort comes from to be able to invest. Because any investments, you're assuming risk, whether that's the stock market or something that's been booming for 20 years or consistently growing, or if it's something maybe that's just launching in the past 2 to 5 years, you're assuming risk with anything. But again, I think if somebody goes in with knowledge and understanding, they look at different points to gather data to make that investment, then yeah, more power to you. Like I said, everybody has their own strategies. And so I think a lot of the comfort comes from the research and understanding the data is what you're putting your money into, and then go from there.
Yeah, and I think that's real, and I think the difference with a lot of different people, and I guess how I conquer the fear of the risk that I'm going to take for an investment is one of two ways. If I could explain it, is one of my ways is one, anytime I'm making a decision when it comes to me and my family's money, it's going to be, as you mentioned, a data-driven decision. So whether it's okay, I'm going to invest in a rental property. We know there's lots of historical data on the mortgage industry and kind of the benefits of it and the negatives as well. So it's not just all just smiles and Hallmark cards. So I can understand I can kind of paint a picture of what that risk is going to be. And then the second one that kind of gets me comfortable is that I'll never play with house money. I'll just put it that way, like in casino terms. So any money that's needed to provide for me and mine, I'm not using any of that money for any investment. That's for ends meet. That's keeping a roof over our head, food in our belly, and clothes on our back.
Yeah, for sure.
Anything after that, now it's a sliding scale of risk that I'm willing to accept depending on what the investment is, but it has to be data driven. Yeah. And that's kind of one of the we've discussed cryptos quite extensively, and I think cryptos can be a very very good investment, but I just don't understand the data as much in order to kind of engage in that. And so I'm definitely, that's a shout out to anybody listening. If you are extremely smart on crypto and the inner workings on it and the theses behind some of these specific coins. And kind of your methodology and approach for investing in crypto, man, come join J-Flu and I. Come join us.
Yeah, for sure. I'm in the same boat with you when it comes to crypto. I've done some research, and I have crypto in my portfolio. I mean, it's a really small percentage of my portfolio. I'd say my overall net worth, crypto is probably less than 5% of what I invest in. But I do know that the returns, depending on which type of coin that you're investing in, et cetera, that the returns are extremely profitable. So yeah, if there's anybody out there who has some expertise or that's a large part of their portfolio and they understand exactly kind of the history and are comfortable in that particular sector, for sure, I'd love to learn more about that. But again, I do invest into it, but it's a very, very small portion of my portfolio.
Yeah, same here. And I would say right now it's probably maybe 1% of my portfolio. And I think,
Yeah.
it's I'm a big gun shy, and I think I just need, I need more education. Yeah,
Yeah.
yeah, definitely. When folks come
But
out
that's
there.
the way you go about it. I mean, regardless of what you're going to invest in, I think that everybody has to go and kind of educate themselves about it to get that comfort to be able to go in and say, okay, I'm taking a risk here, but based on this data, I'm willing to take this risk because of X, Y, Z. So, yeah, I mean, I think that's the best way to go about it.
Yeah, yeah. Like when I think of, you mentioned, and like I said, I can't echo enough, how aligned we are when it comes to kind of our strategy and kind of our outlook on things. And one of the things that helps me reduce the risk of buying a rental property soon is that I know that even if I'm a long-term investor, so for me, I'm looking at this from a 20-year, 30-year standpoint,
Right.
whereas I'm not really. Let's say I buy a rental property, and the housing market tumbles like it did, a little over a decade ago. As long as it's still a viable property that I can then rent to someone else,
Right.
because people will always still need somewhere to live, then it's still a sound investment for me.
And that's
Yeah,
the crazy thing when
yeah,
you think about it, the mindset may not be as traditional, but for me, if I invested in rental property, which personally, if I was going to invest in rental property, I would like to go in and buy it straight out cash.
yeah,
If I was going to do that, if the stock market or if the housing market was to start crashing, property values going down, I'm almost more excited at that point. I'm almost trying to figure out, okay, what else can I invest in and put my money into? Because it is a long-term investment. It's not something I was looking to get a quick flip on and a quick turnaround on when it comes to that particular portion of my portfolio.
yeah. Shoot, like our scenario we talked about earlier today, if I can make $250 to $500 a month,
Yeah.
right, on top of a maybe 2 to 3%, increase in value, like I feel like I'm eating. That's,
Yeah.
the numbers on that same, $150,000 house we talked about. You can increase your worth, or the cash, because what people don't realize is, like, when a house increases in value, that you don't see that money in your bank account,
Right.
but that's still cash that you have access to should you need to, whether you're selling it, whether you're going to refinance it, you have an emergency that you need money, whatever the case may be, or you want to deploy towards a new investment. That money that goes into a home is still your money. Now, obviously, when a housing market crashes, that eats into, your property value or your equity, and that affects you there. But when you're, like I say, when you're not looking to benefit from, the cash flow of a property immediately, I think your tolerance for those deviations in the market, will probably increase. And I know that's kind of how my outlook. Like, when I look at some of these side hustles, or other streams of, income, I don't see that as money that I will access or utilize today, whether that be, my gains in the stock market, whether that be gains in crypto or real estate. Quite frankly, the new business that started, I don't really see the capital in that business as money that I'm probably going to deploy today.
Not at all.
I see these as, and if I do deploy it, it's probably going to get reinvested, and it's going to get reinvested in the area that's going to then get me more unrealized gains, money that I'm probably not going to look to access today.
Yeah. Yeah, I agree. I mean, all those things that you were talking about, you're talking about the traditional investment strategies. You're talking about kind of the newer age modern investment strategies with digital currency, et cetera, or you're talking about side hustles, investing in yourself, for a business or a brand that you're trying to start up. In all of those, for the most part, it's going to be a long play if you do want your money or your return on investment to kind of reach its max potential. Because I mean, and I dropped in one of my last videos I put out, one of the side hustles that I do that I'm mostly dedicated to is reselling. And so, for example, when I started that, what I really like about it is you don't have to put a lot of money up front to get started. It's really just based on, if you're able to go out, you find something, what's your tolerance or what's your threshold for, how much money you want to spend to try to flip something. And when I started out, it was all thrift stores, so I didn't want to spend anything over $10. If I saw something more than $10, I would almost literally flinch. And so then if I found something, I'm like, okay, I'm putting like $4 into this. I see it selling for like $25 here, so let me go ahead and get that. And if I was able to get that sell, I still wouldn't be touching that money, that profit, because I wanted to snowball that, because it's going to be more of a long-term play. Now, eventually, yes, I do want to be able to eat off of that, but it's going to be a while up until I start seeing those types of returns where I can pull anything out of it.
Yeah, and so what I hear a couple of different things when you say that. I hear that, one, your tolerance for risk when it came to your initial investment was relatively low, and
Yeah.
you went with the area that you were comfortable with. And then the second thing that I'm hearing is that you not only, you didn't try to reap the benefits of your immediate success by turning around and going and spending that money. You reinvested that, right? So now that's off your same initial investment. You took that money, you compounded it, and you bought more inventory, and you let it snowball. Like, I think that approach for people may be different, whereas somebody else may come into this where, well, I'm gonna come into this with initial, $10,000, right? Their risk.
I can't say that that's wrong.
That's right. Meaning, and so that's why I say there's no right or wrong, I guess, on how you approach it. It's just do like Justin did. You took your tolerance for that risk and you made it so, right? And you were willing to be as patient and work as hard as you needed to make it snowball, right? And another thing I think with your approach that I like is that I'd much rather learn a lesson with $10, right? That could cost me money or make some mistakes or fumble a little bit with $10 versus $10,000. So that's kind of another way when I approach, I guess, how I'm putting my money or how I'm investing it, is that like that nibbling approach, because I really try to squeeze the lessons out of the new things that I'm doing. Because when it comes to money, a lot of these things are a little intimidating and a little scary, like the stock market. The first time I invested in the stock market, I'm sitting there, I was just nibbling, and learning trends and learning understanding.
I was putting $200 into the market
right
when I first started, and it's all relative. Even to your point, and the wild thing is, like, when you say, we're starting off nibbling, we put $10 in because if we're going to make a mistake, much rather do it with $10 than $10K, right? But even in that hand, that's relative also. Depending on what your net worth is, $10K could be a drop in a bucket.
Exactly.
So I think all of this, and I want to say, throughout this podcast, you're going to learn I'm extremely risk averse. I don't like assuming a lot of risk for anything. And so that's why when it comes to the types of side hustles that I do, it's really not a lot of money or overhead that you have in any of that. But I think that it's important to say, tracking all of this back, because we're talking a lot about investments, I do feel like you have to protect yourself financially, whether you're an individual, you have a family, protecting the four walls, like you mentioned. You got to put food on the table. You got certain bills and expenses that you have to be able to take care of. I think all those things need to take priority. And then in addition to that, for me, again, personally, when it comes to debt, I'm allergic to it. I don't endorse it. And so when you're looking at investing, I feel like it's very important to be able to manage anything you've done from a debt perspective, or clearing that out, or maintaining it, controlling it, before you look at putting your money into the market. Because it's one thing to assume the risk of putting your money into the market and trying to get those returns that are projected. But then it's another thing when you have something battling it on the back end, when you have debt and you're paying interest on either credit cards or vehicles or whatever, and that's eating away at the potential returns you have from the investment side. So personally, I think it's really important to be able to manage or clear out your debt before you look at investing.
And I think that's really sound advice to provide, because, like I said, that's any type of financial literature that I've read. It seems to point to take care of the debt before you start to invest. So it seems like the methodology seems to flow like take care of your debt, build your your emergency savings, and then start investing.
Right.
Now, obviously, the numbers on those are different for everybody. Like I've heard, when it comes to it seems to be unanimous. Take care of your debt, but then the bad debt, right? The stuff the things that are not assets, maybe the things that are liabilities, like most likely our vehicles, our credit cards. Those
Right.
things are more liabilities, but I'd like to know when it comes to like the emergency savings, what's your philosophy on that? Because I've heard some people say 3 to 6 months of your normal living expenses is something that you should maintain in your emergency savings. For me, personally, that's not enough for me. Like I feel a lot more comfortable, right? And I think everybody's approach is this. Why there's multiple different ways to do this. And I think everybody's situation is different. But like for me, I leave at least a year of living for my family and I, and that's probably the minimum amount I would feel comfortable with. Like, what's your philosophy on
That's a good point, man. And again, I think a lot of these things really come down to like personal experiences, because the rule of thumb that I tend to go by is 3 to 6 months of expenses. That's the rule of thumb that I go by. But in the same hand, and we're a lot different. You have a family to take care of, and there are some people that experience a lot more adversity than others. So they may not even feel comfortable with the 6 months. To your point, having a year to feel comfortable. I think it differs based on experience.
Yeah.
And then one of the things, because you could argue it both ways. So if you look at the emergency fund, what is that designed to do? That's designed to protect you if something should come up. So you're not having to pull money out of your investments or pull money out of a 401k or something like that. That's going to cost you anyway from a tax or fee perspective. So you have that emergency fund there to protect you. It's not necessarily designed to give you ROI or for that money to grow. So that's something else you got to think about. But I could also argue on the same hand, if somebody's looking at setting up an emergency fund, 3 to 6 months of expenses, if they do more than that, okay, what is that money doing? If you're looking at inflation, if you're looking at trying to keep up or contend with that, then some people may say, okay, and I'm taking the rule of thumb that I use for an example of 3 to 6 months. They say, okay, I'm only doing 3 months. Like I'll take 3 months of business. Everything else, I need that to make bread for me. I can't say that's wrong either. I think a lot of this is really based on personal experience, where you come from, how much adversity financially that you have endured before, and that kind of creates some of the habits or your comfort zones moving forward.
And I think that's the cool thing about money, because like all the time, whenever we read something or watch something, you have these prescriptive videos that kind of say, hey, do it this way. Anything more than this or anything less than this is wrong, pretty much. And I think I like our approach, because our approach is like, hey, this way works for me. Or this way does not work for me. So I don't, or this way makes me comfortable and this way does not. And I think I think when it comes to building wealth, that's probably the outside of taking care of debt and the finances and emergency plans and not emergency plans, but emergency funds, is start to assess your tolerance for risk. I've said that probably 5 times throughout this video, but really starting to feel where our comfort zone is, because we talked about in the last episode, our why and kind of what we're trying to hope to accomplish. But in the process of accomplishing that financial independence and building wealth, I don't want this to be a stressful ordeal. Like that's kind of where we're and that may, I guess, reduce my tolerance for risk, but I'm fine with that too. So if that means that, if let's say I had the opportunity to grow my net worth at $250,000 a year, but because my tolerance for risk and or stress associated with it is a lot lower, and that causes me to only grow mine at 50 or 100 grand a year, I think I am completely comfortable with that decision making, because for me, I truly assessed I guess my tolerance, and I truly it made a data driven decision. Because I look at data in a way where I can paint you, for me, I can paint you my personal picture and tell you how I can deploy my capital in the most aggressive way possible, and probably what type of returns I'd get from that. But just not comfortable, and it's this weird point where it's this comfort zone, and I think like how you feel when it comes to debt. Like you probably could deploy it, deploy your money and have multiple rental properties if you wanted to right now, but that comfort place is like nope. And I think the key takeaway to that is that when we talk about this on our podcast, we are willing to accept all different points of views and the multiple different ways to approach the journey of building wealth.
Yeah. A couple points that I wanted to talk about before wrapping things up. There's two things I think that are very important coming out of some of the things that we're talking about. So, being able or looking at different vehicles to invest your money to get a return on investment, it should not be stressful. I think that stress comes into play when either number one, you don't have knowledge behind what you're doing, or number two, if you're leaving a lot hanging in the balance. And when I say that, I mean you're assuming a lot of risk where either maybe you have a lot of debt that could affect like your month-to-month bills, and you're looking at investing in certain things. So at that point, you're going to be hyper focused on what you're investing in, probably checking it multiple times a day to see if that's growing or what's happening with it. So I think, number one, I think it's important for managing your personal finance and understanding that, when you're looking at debt or certain things like that, that's managed. Hey, Blake.
Get him.
Blake. Hey, chill. But anyway,
he got up over there.
But anyway, when it comes to managing that, come here. When it comes to managing that, I think it's important that people understand or are able to have it managed or have it cleared out before they look at investing. And then the second important point I think is when it comes to knowledge, that at least go out and research and get an understanding of what you're investing in, so you can feel that comfort in doing so. And I'll bring up, I used to watch one of my favorite shows I used to watch. Don't judge me, but King of Queens. I don't know if you ever watched that show ever before.
Heard of it, never watched it.
All right, so Kevin James is hilarious in that show to me. But there's one episode where they're talking about so both of them. Okay, to set the tone, it's a married couple, and both of them had just gotten a raise, or they had just gotten a tax return or something. And they're like, hey, we got some extra disposable cash here. What should we do with it? And the wife said something like, oh, I talked to a guy at work and he invested in this one stock. And he said it's 4x its money or its returns. And so they're like, oh, that sounds great. Let's go ahead and put some money into that, right? They didn't have any understanding of what it they didn't have any understanding of what the stock was. And then when they started looking at it, they started checking it every day, and they started seeing that it started to go down and started to decrease. Then they were like, hey, what is this stock anyway? So they looked up what it was, and it was some internet e-commerce something or other. And they're like, okay. They said, well, let's go ahead and just kind of keep it in here and see what it does. And then it kept going down. So at that point, they got nervous and they pulled all their money out. And as soon as they did that, of course, it jumps up and it like 8x's its money in its return. So then they jump right back in and they buy it again. And then guess what happens? So, in that scenario, and I know that's a sitcom, but I think that is very real when it comes from people that don't really have an understanding or educate themselves or take that time before they look at investing into the stock market. I think it's really important. Just like if you're gonna start a business, in most cases, somebody's going to understand what they want to do some research into, okay, is this something that's profitable before they actually start investing time and potentially money into launching that. I think it's the same way with the stock market also.
Boom. Yeah. Hey, from a personal perspective, part of that sitcom was true for me during the pandemic with a lot more time on my hands. And I was still,
Oh
like, I
yeah.
would say, before that, my investments in the stock market had mostly been an index fund. And, and knowing that that was a full long term investment. But then when I started investing in some individual stocks, and, I had a lot more time on my hands being home during like the shutdowns and stuff like that during the early part of the pandemic. And I noticed myself checking it multiple times throughout the day.
Yeah.
And I started to really realize, like, man, this is a little overwhelming for me. And and then when I would see those fluctuations, it started to forget that my whole strategy is long term. It does not matter if it drops considerably in one day or if it increases considerably the next day. I've invested in companies or businesses that I have a long term thesis about, like, or one that I believe in the direction that they're going, or I think they have an extremely viable uh, business,
Yeah.
and that's going to be massive in the future. Those are the things that'll drive me to invest in it. And it's definitely not a this year, next year, really probably not even a next decade type of investments. I'm thinking 2 decades down the line. So the small ripples that happen in any given day really have no major impact on the long term of that investment. And so I think that the being long term also reduces a lot of stress for me. Uh,
Yeah.
gives me
Yeah.
that.
I agree with that. And I mean, that's where I find solace. Solace. I don't know if I'm using that word right. I think I am. But that's where I'm comfortable because so for me, when I look at, and this could be really in any vehicle that you're looking at, whether it's crypto, whether it's the stock market, whether it's real estate, when you find comfort in it based on just your understanding of it, like for example, I'm fairly heavy into the stock market itself. And the reason why is, you can look at, and this is my strategy really, I can look at the S&P 500, which you're looking at some of the larger organizations and successful companies, top 500 companies within the nation. And so when you look at that, you can go back 30 years, maybe more than that, to see that it has been consistent growth and have an average year over year return. So you can see that data trending. So that's where I'm comfortable. And even if something was to hit, you look at Great Depression, you look at Y2K, you look at the housing market crash, you look at the pandemic, in all of those instances, the market was completely tanking. But then what happened? It came back and then it 2x'd maybe where it was before that happened. So that's where I'm comfortable, and that's why I utilize a strategy that I do. So again, I think it's important to this dude over here. I think it's important to do your research and just understand it before you go into investing. And again, I can't say person A, B, or C, the way that they operate or invest is wrong.
Right. Yeah, this is just their way. And
Yeah.
as we say, what are they? They're the subject matter experts of their own opinion.
Yep.
They're experts of their own opinion.
Dang, I'm an expert in my own opinion. So
Yeah.
there's stuff that I've experienced personally that I've been through where I'm like, yeah, for the same example of like an emergency fund, if somebody had a lot of emergencies come up to where their back was against the wall so many times, they probably gonna want that year, even
Yeah.
though like
Exactly.
3 6 months is kind of the rule of thumb. And so
Yeah.
I think it's the same way with anything.
Right. If their job situation wasn't as stable, there's a lot of variables that would drive, I guess, some people's understanding. And I would take this as a time to kind of advise that even when we get financial advice from these books or different people's circumstances, that just like a recipe that you find online, you got to kind of make that your own after you read it anyway. And so I think these
Yeah,
cooker,
some people want to change it up a little bit, add a little
yeah,
bit more salt, something.
they made these pancakes. Well, I put extra cinnamon up in there, put some brown sugar instead of white sugar. But the
Sweeter.
recipe, yeah, the recipe is a recipe. But I think it's important to kind of realize that these cookie cutter approaches to things does not necessarily work for everybody in their circumstances.
Yeah, you touching on it, man. You touching on something that go way beyond personal finance. I personally feel like, if there was a place or a community that was really just open-minded to certain things, where they're having a one-track mind and closed-minded to everything, I think that would make better for a lot of areas, not only finance, but yeah.
Yeah. Well, just notified.
Yeah.
We hitting the 45-minute mark, you
Yes,
know,
sir.
of our second episode. We made it.
Yeah, G.
So it was already a monumental feat of the first episode. The fact that we touched base and hit a second episode is even bigger.
Yeah, no, for sure, bro.
Before we close this out, you want to take a few minutes to pitch some of your new channels? We can include them on the links.
Oh yeah, I can drop it, man. I could drop it.
Yeah. Let our followers know where they can see more of your content.
Yeah, I think if my name is displayed on this recording whenever it goes up, just notified. So I have a few different channels on a few different platforms. It's just notified everywhere. On YouTube, I have a main channel. It's actually just notified 2 words. But then I have a gaming channel, just notified gaming. I also stream on Twitch. That's going to be just notified as well. And then all of my socials, you look at Facebook, Instagram, what have you, everything the same.
Boom, just notified. Right. Hey man, any last words? We can close this thing out. Another success.
Hey, I'm good. I was gonna say I appreciate you going through to get everything set up. StreamYard is actually live. I kind of like it, bro, from our last one, 100% smooth, night and day.
Boom. Yeah, and us being able to be side by side. Yep.
Yeah, for sure.
Well, hey, listeners, followers, viewers, go ahead and like and subscribe if you haven't already. And we appreciate you taking the time to listen to, Justin and I and kind of our way of going towards these finances and I guess our journey of building wealth. And so we appreciate you and stay tuned. We'll be back at you for more.
For sure. All right, till next time, y'all.
Next time.